Welcome to the Deep Dive. We're the show that takes complex topics, pulls out the key insights, and gives you a solid understanding fast. Today, we're jumping into something that's, well, it's really hitting its stride now. Decentralized finance. DeFi.
It really is. It's a huge area. And, looking back, it's kind of amazing how some old financial problems just stuck around. Like, think about a Western Union transfer back in 1873. They charged a 3% fee.
Wow, 1873.
Yeah. And today, 150 years later, we're still often paying 3% on credit cards.
Yeah.
And sending money overseas. Sometimes 5, even 7%.
It's incredible despite all the tech.
Exactly. It shows that traditional finance hasn't really fixed some basic expensive issues.
That really sets the stage perfectly because that's our goal today, right? To cut through all the hype and give you a clear path to understanding DeFi. We're not just talking about tweaking the old system. This is about potentially rebuilding finance, like completely from the ground up. So we'll cover what it is, what problems it's trying to fix, how it works with real examples, and definitely the risks involved. By the end, you should feel pretty well informed about this whole movement.
Okay, so let's start with why. Why this big push for change? What's wrong with the old way?
Right, let's peel back those layers. People often talk about traditional finance having sort of unnecessary bloat, all these middle steps. We mentioned the 3% credit card fees, those remittance costs.
Yeah.
And even just settling a stock trade. In the age of the internet, it still takes 2 days. T+2, they call it. Seems kind of slow, doesn't it?
It really does. And it's not just about speed. Think about physical banks. All that overhead, the buildings, the staff, it costs a lot. And that means savers get tiny interest rates on deposits while borrowers face higher loan rates.
So it squeezes both ends.
Pretty much. And think about the bigger picture, the economy. If borrowing is too expensive, good ideas might not get funded. Imagine an entrepreneur. Great idea, maybe a 20% return, but their only option is a credit card loan at 24%.
Yeah.
That project, probably dead in the water.
Yeah, that kills innovation. And it's not just cost, it's also about who even gets in the system. Our sources point out, 1.7 billion people globally don't even have bank accounts?
It's a huge number.
That locks them out of so much. Even small businesses that are banked often can't get traditional loans, so they end up relying on expensive credit cards.
Right. Which brings up a fundamental question. Does the current system really fund the best ideas? Or is it more about, who you are, what you already have? It can definitely limit opportunity for a lot of people. And then there's the control aspect.
Centralization.
Exactly.
Sure.
Central banks control money supply, interest rates, and the banking system itself is often really concentrated. Like in the U.S., the top 4 banks hold something like 44% of all insured deposits.
That's a lot of power in a few hands.
Yeah.
And what about transparency? As a customer, do I really know what's going on?
Not really, no. You have very little idea about your bank's actual financial health. And comparing loan rates effectively, it's tough. The whole thing feels quite opaque. Plus, the different parts of the system don't talk to each other very well. It's siloed. Moving money between institutions. Slow, expensive. A wire transfer might take days.
Yeah, I've felt that pain.
And we see big players trying to adapt, like Visa wanting to buy Plaid, which helps connect bank accounts. But maybe that was more about delaying disruption than solving the core problems, buying time,
So, okay, we've got inefficiency, exclusion, lack of transparency, centralized control, and it's all fragmented, sounds like.
Yeah.
Ripe for reinvention.
Definitely.
All right, so we've laid out the problems. Now let's talk about how DeFi starts building something new. What are the fundamental pieces?
Well, if you think way back, trade started as barter, direct peer-to-peer, but pretty inefficient. Then money came along, sometimes decentralized things like shells. Then eventually government-backed fiat currency, which is mostly centralized.
Right.
Bitcoin, though, back in 2008 with Satoshi Nakamoto's white paper. That was a huge shift. It was a return to the idea of peer-to-peer, but for the digital world, decentralizing control over value.
And the key tech breakthrough there was stopping people from just copying digital money, right? The double spend problem.
Exactly. Bitcoin combined a few existing ideas in a novel way. It used a blockchain, basically a shared time-stamped ledger, with a consensus method called proof of work. This combo solved double spending for a digital asset. Suddenly you had real digital scarcity, you couldn't censor transactions easily, and users truly owned their keys, their coins. That was revolutionary.
Okay, so Bitcoin proved digital scarcity was possible, but Ethereum came next and added another layer, didn't it? What was that logical extension?
Right, Ethereum, launched around 2015 by Vitalik Buterin and others, took the blockchain concept and made it programmable. It introduced smart contracts.
Programmable money.
Kind of, yeah. Think of smart contracts as code that runs on the blockchain. This code can hold assets, it can control data, and it automatically enforces rules and agreements defined within it. So if you imagine Ethereum as this giant shared global computer, smart contracts are like the apps running on it.
Okay, interesting analogy. And like using any computer, there's a cost. On Ethereum, that's gas fees. What's their purpose?
Gas fees are basically payments for commutation. Every little operation on Ethereum costs a tiny bit of gas. You pay these fees to miners, or now validators, who run the network. It's really important because it stops people from just clogging the network with useless or malicious code like infinite loops. Makes
Well,
it tax expensive.
Prevents spam,
Yeah.
essentially.
And Ethereum also brought us standard ways to create tokens. ERC20 is huge. That's for fungible tokens, things that are interchangeable, like currency. And ERC 721 is for non-fungible tokens, NFTs. Unique things like digital art or maybe even a deed representing a specific loan. These standards make everything work together much more smoothly.
Makes sense. But if these blockchains are their own separate digital worlds, how do they get information from the real world? Like, say, the price of Apple stock.
Good question. That's the Oracle problem. Blockchains, by themselves, are isolated. They don't know external data. Oracles are the solution. There's services or protocols that securely feed verified real-world data onto the blockchain so smart contracts can use it. Crucial piece.
Okay, so oracles bridge that gap, and you also mentioned something critical for practical finance, stablecoins.
Absolutely vital. Cryptocurrencies like Bitcoin or Ether can be really volatile, right? Prices swing wildly. Stablecoins like USDT, USDC, DAI are designed to minimize that volatility. They're usually pegged to something stable, most often the US dollar. They provide that stable base layer needed for things like lending, borrowing, payments.
Without them, it'd be much harder to use DeFi for everyday financial stuff.
Definitely. And all this infrastructure, the blockchain, smart contracts, Oracle, stablecoins, enables these things called decentralized applications or dApps.
So what are dApps, and how do they relate to DAOs, decentralized autonomous organizations?
dApps are basically software built using smart contracts. They run on the blockchain, they're generally open source, permissionless meaning anyone can use them, and resistant to censorship. DAOs take it a step further into governance. They're organizations where the rules, the voting, even how funds are managed are all written into smart contracts. Often, holding the DAO's specific token gives you voting power. It's a way to have community-led organizations, not top-down control. A really radical idea.
Wow, okay. So those are the core building blocks. Now, how do developers actually use these pieces to build financial tools? Let's get into the DeFi primitive.
Right, the tools in the toolkit. One fundamental concept on Ethereum is atomic transactions, atomicity.
What does that mean exactly?
It means any transaction involving multiple steps either succeeds completely or it fails completely and reverts. Everything goes back to how it was before the transaction started. So imagine a complex trade involving swapping tokens across 3 different protocols. If any single part of that fails, the whole thing unwinds instantly. Your funds are never stuck halfway or lost in limbo. It's a huge safety feature.
That's reassuring. Okay, so atomicity is key. And we talked about ERC20 tokens. You can break those down further, can't you?
Yeah, we can think about their purpose. Some are like equity tokens. They represent ownership in something, maybe a share in a pool of assets. Then you have utility tokens. You need these to actually use a specific service or protocol, or they might drive the economics of the system. Stablecoins like DAI fit here, or Synthetics' SNX token, which is used as collateral within its system.
Okay, equity, utility, and the third type, you mentioned governance before.
Right, governance tokens. These are really interesting. Tokens like MakerDAO's MKR or Compound COMP give holders the right to vote on proposals for changing the protocol. How should fees be set? What new features should be added? The token holders decide. It's how these platforms evolve in a decentralized way.
Community control baked into the system.
Very cool. Now, what about changing the supply of these tokens? You hear about minting and burning. Yep. Minting just means creating new tokens, increasing the supply. Burning means destroying tokens, reducing the supply. These are often controlled by the smart contract rules. And related to supply is the idea of a bonding curve.
Bonding curve. It sounds technical. What is it?
It's essentially a smart contract that automatically sets the price of a token based on its current supply, following a predefined mathematical curve. So maybe the contract says the first token costs 1 ETH, the second costs 2 ETH, the third costs 3 ETH, and so on. That's a simple linear bonding curve. It's a way to programmatically manage price and supply, and it can naturally reward early buyers as demand increases.
Automatically rewarding early adopters. Clever. Now, to make all this work smoothly, you need people to act correctly, right? How does DeFi handle incentives?
Through a mix of carrots and sticks, basically. Positive incentives include things like staking rewards. You lock up your tokens to help secure the network or provide liquidity, and you earn more tokens as a reward. There are also direct rewards for performing specific jobs, like keepers. These are often bots that monitor the system and perform necessary actions, like liquidating loans that fall below their collateral level. They get paid a fee for doing this.
Okay, those are the carrots. What about the stick?
Negative incentives or penalties. The main one is slashing. If you're staking tokens and you misbehave, maybe you try to cheat the system or your validator node goes offline, the protocol can automatically slash or destroy a portion of your staked tokens. Keeps everyone honest.
Makes sense. Carrots and sticks built into the code.
Oh.
Okay, let's talk about a core financial activity, exchanging assets. In DeFi, that's swaps on decentralized exchanges, DEX, and this is where AMMs come in, automated market makers.
Yes, AMMs are a huge innovation, pioneered by platforms like Uniswap. Traditional exchanges use an order book, buyers and sellers list their prices, and the exchange matches them.
Right, like the stock market.
Exactly. But doing that constantly on a blockchain is slow and expensive because every order change needs a transaction. AMMs work differently. They use pools of tokens supplied by users' liquidity providers. Instead of matching orders, they use a mathematical formula to always offer a price based on the ratio of tokens in the pool.
So there's always liquidity available.
Pretty much, yeah. No need to wait for a counterparty. And this leads to that amazing concept of DeFi Legos. Because these liquidity pools are just smart contracts, other smart contracts can plug directly into them. You can chain swaps together, build complex strategies. It's incredibly composable.
That DeFi Legos idea really captures the potential. Building new financial tools by snapping together existing open protocols. But providing liquidity isn't risk-free, is it? What's this impermanent loss?
Right, that's the main risk for liquidity providers and AMMs. Think of it as an opportunity cost. Let's say you provide liquidity for ETH and DAI. If the price of ETH shoots up relative to DAI, arbitrage traders will buy the cheaper ETH from the pool and sell DAI into it, rebalancing the pool. As a liquidity provider, you end up holding more DAI and less ETH than if you had just held the assets separately. So if ETH keeps going up, you might have made more money just holding. The loss is impermanent because if prices go back to where they started, the loss disappears. But if they diverge significantly, it can be substantial.
Okay, so it's the risk you take for earning trading fees.
Exactly, which is why providing liquidity for pairs of stablecoins like USDC and DAI is popular. Since their prices don't move much relative to each other, the impermanent loss risk is minimal.
Got it. Now, last, primitive loans.
Right.
Most DeFi loans need over-collateralization, right, because of anonymity.
Yes, generally. Since the protocol doesn't know who you are, it needs enough collateral to cover the loan if you default, or if the collateral value drops. If your collateral value falls below a certain threshold, those keepers we mentioned will trigger a liquidation sell-off the collateral to repay the loan.
But then there's this other type, flash loans. These sound wild, uncollateralized, instantaneous.
They are pretty mind-bending. A flash loan is a loan that you borrow and repay within the very same transaction. It happens almost instantly.
Yeah.
Because it's all atomic, the protocol knows it will get its money back by the end of the transaction or the whole thing reverts. So there's zero risk for the lender.
Zero risk. Wow.
Zero counterparty risk, zero duration risk. And the implications are huge. It means anyone, even without massive capital, can instantly borrow millions for that single transaction to perform arbitrage, refinance loans, or execute other complex strategies. It really democratizes access to capital in a way traditional finance never could.
Truly rebuilding from the ground up, like you said. Okay, that's a solid grasp of the primitives. Now let's see them combined in some major DeFi applications. Where should we start?
Lending and credit is a great place. MakerDAO is kind of the OG here. They created DAI, which is probably the most well-known decentralized stablecoin. How it works is you lock up collateral, like ETH, into a smart contract called a vault. Then you can mint DAI against that collateral, but you have to over-collateralize. Say, deposit $1,000 worth of ETH. Maybe you can mint 500 DAI if the requirement is 200%.
Okay, so you maintain a buffer. What happens if my ETH price drops?
If your collateralization ratio falls below a minimum threshold, maybe 150%, your vault becomes eligible for liquidation. A caper bot will then step in, repay your DAI debt by selling off just enough of your ETH collateral, take a small penalty fee, and return any remaining ETH to you. MakerDAO keeps the DAI peg stable using various levers like stability fees, interest rate, the DAI savings rate, and controlling how much DAI can be minted against different assets, all decided by MKR token holders through governance.
Makes sense. Then there's Compound, another big name in lending. How does it differ?
Compound created lending pools for various assets. When you deposit, say, DAI, you receive CDAI tokens back. These 8 tokens represent your share of the pool and automatically earn interest as borrowers pay it. The cool thing is, these 8 tokens themselves become assets. You can transfer them or even use your CDAI as collateral in another DeFi protocol to borrow something else. That's the DeFi Legos in action.
Composability again.
Exactly. Compound also pioneered distributing its governance token, COMP, to users of the protocol, both borrowers and lenders. This incentivized people to provide liquidity and participate, effectively giving ownership to the users.
And Aave built on that foundation.
Yeah, Aave took inspiration from Compound but added more features, more token types, isolated markets with different risk parameters, and they became a major hub for flash loans.
Ah, flash loans again. Can you walk through that refinancing example using Aave and Compound?
Sure. Let's say you borrowed USDC on Compound, and the interest rate is, 10%. But you notice Aave is offering loans against the same collateral for only 6%. You could initiate an Aave flash loan for the exact amount of your Compound debt. In that single atomic transaction, the flash loan instantly pays off your Compound debt. This unlocks your collateral on Compound. You immediately withdraw that collateral, deposit it into Aave, borrow USDC from Aave at the lower 6% rate, and then instantly repay the Aave flash loan. Boom. Refinanced in seconds with zero upfront capital, just paying the small flash loan fee.
That's incredibly powerful, all in one block.
Yep. Aave also offers things like stable interest rates for predictable borrowing costs, and even credit delegation, where someone can delegate their borrowing power to someone else based on trust, enabling under-collateralized loans in specific cases.
Fascinating. Okay, let's shift to exchanges. Uniswap is the big AMM example. How does it actually price things?
Uniswap uses a simple but elegant formula, XY equals K, where X and Y are the amounts of the 2 tokens in a liquidity pool, and K is a constant. When someone trades, they add one token and remove the other, changing X and Y, but the product K must remain constant, ignoring fees for simplicity. This formula automatically determines the price. The more liquidity in the pool, the bigger X and Y, the less impact a trade has on the price, meaning lower slippage. Liquidity providers deposit pairs of tokens into these pools and earn fees, usually 0.3% on Uniswap V2, V3 pools, from trades happening in their pool. But again, they face that impermanent loss risk.
Right. And Uniswap also has flash swaps. How are they different from flash loans?
Very similar concepts, slightly different mechanism. With a flash swap, you can receive the output token from a trade before you've provided the input token. As long as by the end of the transaction, you've paid back the required input amount plus fees, it all works. This is amazing for arbitrage. If you see ETH is cheaper on Uniswap than on another DEX, say SushiSwap, you could use a flash swap on Uniswap to get cheap ETH, immediately sell it on SushiSwap for a profit, and then pay back Uniswap for the initial ETH, all in one transaction, needing zero capital to start.
Mind-blowing efficiency. And Uniswap also did that huge airdrop, right, with the UNI2.
They did. They distributed UNI governance tokens to anyone who had ever used the protocol, even failed transactions. Over 250,000 wallets got 400 UNI each. It was a massive decentralization of governance and a huge reward for early users.
Okay, what about derivatives, things that derive value from underlying assets?
Yeah, how does DeFi handle that? Several ways. Yield protocol focuses on fixed-rate lending and borrowing. They use Y tokens, which act like zero-coupon bonds on the blockchain. You buy a Y token at a discount, and it becomes redeemable for its face value, like 1 DAI, at a future maturity date. This locks in an interest rate.
So predictability and rates. What else?
DYDX is a major player specializing in margin trading and perpetual futures. They use a hybrid model, an off-chain order book for speed, but on-chain settlement. They offer free flash loans, too, which helps traders quickly access leverage. Their perpetual futures are like traditional futures contracts, tracking the price of, say, Bitcoin, but they never expire. You trade them using initial margin to open the position and maintenance margin to keep it open.
Like leverage trading in traditional markets, but on-chain.
Exactly. And then there's synthetics, which takes a really unique approach. They create synths, synthetic assets like SUSD, synthetic dollar, or SBTC, synthetic Bitcoin. Their value is pegged to real-world assets using price feeds from oracles, mainly Chainlink. To create synths, users have to lock up SNX, the synthetic's native token, as collateral, and at a very high ratio, like 500% or more, because SNX itself can be volatile.
Okay, synthetic assets backed by SNX. What's the unique part?
It's their pooled debt model. When you mint synths, you take on a proportional share of the entire debt pool across all synths in the system. So if you mint SUSD, but the value of Seth and SBTC skyrockets, the total debt in the system increases, and your personal debt increases too, even though you just held SUSD. You profit if the specific synths you hold outperform the overall synth index. It encourages active management and hedging. It's complex, but quite clever.
Definitely complex. Okay, last category. Tokenization. Bringing other assets onto the blockchain, like SET protocol.
Right. Set protocol lets users create sets, which are basically crypto ETFs bundled into a single ERC20 token. You could have a set that holds, say, 50% ETH and 50% BTC. These can be static or dynamic, automatically rebalancing based on rules, like a moving average strategy. They also allow social trading, where you can essentially copy the portfolio of a successful manager, all transparently on-chain, like a decentralized wealth management platform.
Interesting. And the big one for bringing in outside capital,
Whoa.
WBTC, wrapped Bitcoin.
Yeah, WBTC is crucial. Bitcoin has the largest market cap, but it lives on its own blockchain and can't directly participate in Ethereum's DeFi ecosystem. WBTC solves this. It's an ERC20 token on Ethereum, where each WBTC is fully backed one-to-one by actual Bitcoin held securely by a custodian. Users send BTC to a merchant who works with the custodian to mint the equivalent WBTC on Ethereum.
So it's a bridge.
Exactly. It lets all that Bitcoin value flow into Ethereum DeFi to be used as collateral in Maker DA, Liquidity in Uniswap, and so on. Hugely important for connecting these ecosystems.
Okay, wow. That covers a ton of ground on what DeFi can do. The innovation is clearly there, but it can't all be smooth sailing. Let's talk about the risks. What's the biggest one?
Without a doubt, it's smart contract risk. Because everything runs on code, bugs or flaws in that code can be exploited, sometimes disastrously. We've seen major examples. The DAO hack back in 2016 exploited a reentrancy bug, basically. The contract could be tricked into sending funds multiple times before updating its balance. Millions were lost.
That was early days, though. Has it gotten better?
It has. Auditing is much more common now, but exploits still happen. In 2020, BZX got hit by flash loan attacks. Attackers used flash loans to borrow huge sums, manipulate Oracle price feeds for assets within the same transaction, take out undervalued loans or make profitable trades based on that manipulated price, and then repay the flash loan, walking away with millions in profit.
Using flash loans as a weapon, almost.
Essentially, yes. Flash loans give anyone the financial firepower for one transaction to exploit economic vulnerabilities in protocols. Finance also suffered a large exploit in 2021, again involving complex interactions and likely flash loans. Code is complex, and finding every vulnerability is incredibly hard.
So smart contract bugs are a constant threat. What's next? Governance risk.
Yes, DAOs are designed to be community-controlled via tokens, but that introduces the risk of someone acquiring enough tokens, often way less than 51% in practice, to manipulate votes for malicious purposes. There was a case in 2021 with True Seniorage Dollar where an attacker gained enough voting power to push through a proposal that let them mint, I think it was quintillions of new tokens for themselves, which they then dumped.
Wow. So governance can be attacked too. And you mentioned oracles earlier. They're another point of failure.
Definitely. Oracles are critical, but they're also a potential vulnerability. Blockchains need that external data, but how do you ensure the data feed itself is accurate and can't be tampered with? If the cost for an attacker to corrupt the oracle, cost of corruption, is less than the profit they could make by exploiting a protocol that relies on that oracle's bad data, profit from corruption, then there's a clear incentive to attack. We've seen oracle failures or manipulations temporarily cripple protocols before. It's often called one of the hardest remaining problems in DeFi.
Makes sense. It's a trust bottleneck. What about just sheer capacity? Scaling risk.
That's a big one too. Ethereum currently can only handle around 15 transactions per second, give or take. Visa does tens of thousands. During times of high demand, like during market volatility or a popular NFT mint, the network gets congested, gas fees skyrocket, and transactions can become slow or fail. This limits DeFi's ability to handle mainstream adoption right now.
So how do we fix that?
There are solutions in the works. Ethereum's move to proof of stake is part of it. Things like sharding, splitting the blockchain into parallel chains, and especially layer 2 scaling solutions like optimistic rollups or ZK rollups, which process transactions off the main chain for speed and cost savings, then bundle them back. But these are all complex upgrades with their own challenges and trade-offs.
So scaling is a work in progress. Any other specific risks? DEX risks.
Yeah, for DEXs, we already talked about impermanent loss for liquidity providers on AMMs, That's a constant calculation they need to make. For order book-based DEXs, there's also the risk of front-running, where bots see your transaction waiting to be processed and quickly submit their own transaction ahead of yours to profit from the price movement you're about to cause. Though AMMs like Uniswap let you set slippage tolerance to limit this somewhat.
Okay. And what about just holding the crypto itself, custodial risk?
Absolutely. This is fundamental. With DeFi, the ethos is often be your own bank, meaning you hold your private keys. But if you lose those keys, your crypto is gone forever. No password reset, no customer support. We've all heard horror stories, like the guy with hundreds of millions in Bitcoin on a hard drive he couldn't unlock.
The ultimate responsibility.
Exactly. On the flip side, if you don't self-custody and leave your crypto on an exchange or with third party, you're trusting them. And exchanges can get hacked. Think Mt. Gox, Bitfinex. You face counterparty risk.
So damned if you do, damned if you don't, almost.
It's a trade-off you have to consciously make. And finally, looming over everything, regulation.
The elephant in the room.
Yeah, it's still very much a gray area globally. Regulators are trying to figure out how to handle DeFi. We've seen some DEXs block U.S. users because they're unsure about the rules. Some projects, like Basis, even shut down preemptively due to regulatory concerns.
And things like whether tokens are securities, that's a big question, isn't it?
Huge. The SEC in the U.S. is looking closely at governance tokens. Are they investment contracts? Projects like Compound have tried to structure their token distribution carefully to avoid that classification, but the uncertainty remains. Plus, just dealing with taxes on crypto transactions is incredibly complex for users right now.
Okay, so a lot of innovation, but definitely a minefield of risks, too. Code bugs, governance attacks, oracle manipulation, scaling limits, custody choices, and regulatory fog.
That sums it up pretty well. DeFi removes some traditional risks but introduces a whole new set. Solving these is key for wider adoption.
Absolutely. The path forward isn't simple.
Not at all, but the potential is still there.
So let's bring it home. Despite all those hurdles, and they are significant, the core idea behind DeFi is powerful, isn't it? It's this vision of rebuilding finance completely, making it open, accessible to anyone with an internet connection. No more gatekeepers based on geography or wealth, funding ideas based on merit, not connections. Treating a $10 transfer the same as a $10 million one.
And we're already seeing glimpses of that. By cutting out intermediaries, some DeFi protocols can offer better savings rates or lower borrowing costs than traditional banks. Plus, the ability to distribute ownership and value directly back to the users, like Compound and Uniswap did with their tokens, is a fundamentally different way to build and grow a financial network.
Yeah.
It bootstrapped massive value very quickly.
It's a paradigm shift. Now, obviously, the risks, especially around smart contracts and scaling, are real. The system is only as strong as its weakest link, and we've seen links break.
True. But think about this. If we really are building the foundations of a completely new financial system, a shiny new city, as some call it, what kind of things might become possible that we can't even imagine right now within the constraints of traditional finance? What totally new applications will emerge from these DeFi Legos?
That's the exciting question. And maybe the more personal one for you listening is, how will you choose to engage with this? Will you watch from the sidelines, dip a toe in, or dive deeper? It's a landscape that's changing incredibly fast. Definitely a space worth keeping a close eye on.